Welcome to Chapter 10, Closing Entries. In this chapter, we wrap up the accounting cycle by learning how to reset temporary accounts and transfer the period's results into retained earnings. This step ensures our books are clean and ready for the next accounting period. In this chapter, we focus on the final step in the accounting cycle, closing entries. We have two main objectives. First, to close all revenue and expense accounts, and second, to transfer the resulting profit or loss to retained earnings. Revenue accounts are debited their full amount, setting them to zero. A T account or ledger entitled Expense and Revenue Summary is credited. Expense accounts are credited, and Expense and Revenue Summary is debited for their full amount. The excess of revenue over expense is profit. Debit expense and revenue summary, and credit retained earnings. Journal entry 19 is the second closing entry. It is what it says it is, a position statement. All the ledger balances are carried forward from period to period. Back to the notion of closing entries. In our journal entry, we debit revenue for $9,000. That debit sets the revenue account to zero. The corresponding credit is to expense and revenue summary. We use expense and revenue summary to do just that, summarize revenue on the credit side of the account. And as we shall see, we will post expenses to the debit side of the T account. In journal entry 20, we have another closing entry. We debit expense and revenue summary for $4,500 and credit cost of goods sold for $4,500. This sets cost of goods sold to zero. The debit, or left side, of the expense and revenue summary account will have $4,500. Soon we will see what the final disposition of the expense and revenue summary account is. Journal entry 21 shows expense and revenue summary debited for $800. Sales commissions are credited for $800, zeroing out sales commissions. Journal entry 22 debits expense and revenue summary for $700 and credits administrative expense for $700. The credit to the expense account zeroes out that expense. The expense was debited when we recorded it, and here we are crediting it. Debit $700, then credit $700. Here in JE 23, we debit expense and revenue summary for $1,000. We credit marketing expense for $1,000, setting that account to zero. Here in JE 24, we debit expense and revenue summary for $450 and credit depreciation expense for $450. Closing out all expense accounts involves debiting expense and revenue summary and crediting all the expenses. In doing so, we carry the expense amounts to the debit side of expense and revenue summary and zero out the expenses for the period. Like every other expense, we debit expense and revenue summary, in this case for $100. And we credit interest expense for $100. We must carry every expense balance to the debit side of expense and revenue summary and credit the actual expense. Here in JE 26, we debit expense and revenue summary for $150 and credit bad debt expense for $150. In journal entry 27, we debit expense and revenue summary for $500 and we credit income taxes for $500. Income taxes is an expense. A credit to this account zeroes it out for the period. In this slide, we see all the debit entries to expense and revenue summary equal $8,200. On the credit side, the only entry is $9,000, the revenue for the company. If revenue is $9,000 and total expenses are $8,200, then the profit is $800. In debit and credit parlance, revenue of $9,000 minus expenses of $8,200 means the profit is $800. A credit balance in the expense and revenue summary. The last entry, seen on the next slide, debits the expense and revenue summary for $800, zeroing out that account, and carries the $800 profit to a credit to retained earnings, increasing it. Journal entry. 28 is the final closing entry. We debit expense and revenue summary, 800, and credit retained earnings, 800. What is going on here is critical to our understanding of the accounting cycle. Expenses appear on the debit side of expense and revenue summary. Revenues appear on the credit side. When the profit or loss is determined, in this case profit, we close out expense and revenue summary with this journal entry and post a credit to retained earnings. Retained earnings is a capital account, a claim of owners, shareholders, on assets that were earned and retained in the business. It is not money. It is a claim of owners, and it is not a claim on cash. Cash can be used for many purposes in a business, so the claim is an ownership claim on assets, not specifically cash. Consider this. Expenses are closed out to the debit side of expense and revenue summary. Revenue gets closed out to the credit side. Expense and revenue summary gets closed out to retained earnings, a credit for profits, and a debit for losses. From the above, we can say that expenses ultimately are a debit to retained earnings. Retained earnings is a capital account with a normal credit balance, so expenses lower retained earnings. And revenue ultimately ends up as a credit to retained earnings, an increase. This final entry, warning a credit to retained earnings for 800, brings the balance sheet in balance, as we'll see when we examine the trial balance and subsequently financial statements. Here we have a view of the trial balance, showing just the liabilities, common stock, and revenues and expenses closed out. The revenue and the expenses in the trial balance are closed out, and the totals at the bottom maintain debit-credit equality. This is what we call the post-closing trial balance. Notice, the normal debit balance of expenses is closed out with credits for their entire balances. The only credit, sales, is closed out with a debit for $9,000. Here we have the posting to T accounts or ledgers for the closing entries. Journal entry 19, debit to sales, zeroing out the sales account for $9,000. JE 20, credit to cost of sales, zeroing out the expense for $4,500. JE 21, credit to sales commissions, $800. JE 22, credit to admin expense, $700. JE 23, credit to marketing expense, $1,000. JE 24, credit to depreciation expense, $450. Zeroing out means setting the account balance to zero. JE 25, credit to interest expense, $100. JE 26, credit to bad debt expense, $150. JE 27, credit to income taxes, $500. The other statement we can derive from the trial balance is the statement of earnings. We have revenue of $9,000. Cost of sales, $4,500. Gross margin, $3,500. Total operating expenses, $3,100. Net operating income, EBIT, $1,400. Net profit, $800. From the trial balance, we take the account balances and develop the statement of financial position. The company's cash is $4,900. Current assets are $14,450. Equipment is $4,000, less accumulated depreciation, $450. The contra asset or valuation account. Total assets are $18,000. Current liabilities are $6,000. Total liabilities are $7,700. Common stock is $10,000. Dividends, $500. Retained earnings, $800. Total equity, $10,300. Total liabilities and equity, $18,000. Assets do, in fact, equal liabilities and capital. Yeah. Our introduction to financial accounting is, in fact, a college-level course. We have taught this material at the University of California at Berkeley, 3 state colleges in California, and even at the University of Southern California Graduate School of Business. Even though what we are doing seems a lot like bookkeeping, We believe this ground-level approach is critical to our understanding of financial accounting, the language of business.